Good morning and welcome to this version of ABI's Brunch and Learn webinar series. Just a few housekeeping issues. First and foremost, I want to thank my intranet for all of their technical support with these webinars. We really appreciate them and all they do. And secondly, I just wanted to introduce you to your screen. You've got the PowerPoint presentation in the center. You should see our wonderful faces in the corner, and then below the PowerPoint presentation there's an opportunity for you to type in your questions. And I don't know if you guys want to answer those questions as you go, or if you want to kind of save them, or you can kind of decide as you go. But what Chrissy will do is she'll put the questions up there for you, and then you can answer those as you go. So please do feel free to enter your questions. Also, if you're interested in having this PowerPoint presentation, we can email that to you if you'd like to put your email address in that text box. So if you determine that this is valuable, please put that in there and we'll get that off to you right away. So with that, I'm going to go ahead and introduce our speakers. As most of you know, the Advisory Council for ABI is a group of professional services individuals that meet on a monthly basis, and they identify issues facing our business and industry in the state, and then they try to solve those problems. And one of the things that we've heard a lot lately is companies are looking for ways to develop their leaders. And one of the missing components that we've heard from a lot of our members is the basic financial. So a person starts as in a management level that doesn't really have the financial responsibilities within the company, and then they get, promoted and they take new positions, and they're responsible for a lot of this financial oversight. And so this is part of the goal in getting some of those leaders developed, and even as current leaders within the operation, looking at things hopefully in a different perspective. So with that, we've got Elizabeth Ryder and Justin Zimmerman. Elizabeth has been a CPA with 11 years of experience at CliftonLarsonAllen. She provides assurance-related services to financial institutions, commercial and nonprofit entities, has experience with consulting and operation reviews, internal auditing, and compliance services. She graduated from eight years of experience at CLA, and he provides assurance-related services to commercial entities with a focus on manufacturers and construction contractors. Graduate from the University of Northern Iowa. He enjoys volunteering with the Greater Cedar Rapids Home Builders Association, where he is a current board member and part of many other HVA committees. So welcome, and we'll let you get on with the program.
We'll jump in.
Thank you very much. Okay. We'll get this kicked off here. What we're going to talk about today is what all executives need to know about their financial statements. And the key message that we're going to point out is that managing financial information is almost meaningless without the interpretive, non-financial data that we can use to change the future outcome. Okay, I'll give a little bit of background on who we are and who we work for. We are a back in January of 2012, we decided to go through a sideways merger with a firm called Larson-Allen, about the same size as us, and they seemed to be in places we weren't. We were in places they weren't. So we did a sideways merger and actually doubled in size. So we went from a 45 office firm to a 90 office firm, and now we are called CliftonLarsonAllen. So it greatly deepened our resources, and it was a very good thing for our firm. So now we are a top 10 CPA firm that mainly focuses on owners of privately held businesses. One thing that we do not get into is publicly traded companies. We like to focus on the privately held, the closely held businesses of the type of companies here in America, and really the type of companies that drive this economy. So manufacturers and distributors actually represent about 20% of our practice. So pretty good core practice within our firm. So We help our clients improve profitability, reduce risk, build business value, and plan for succession. Getting back into the building business value, you might ask, how do I build business value? Out in the market, a lot of times how the market values your company is usually, a lot of times they'll take EBITDA times a multiplying factor, EBITDA being earnings before interest, taxes, depreciation, and amortization. And so the value of a company is a lot of times taken EBITDA times a multiplying factor. And so if your EBITDA is high and strong in a growing market, a lot of times that factor is a lot higher than it would be for a company that has lower EBITDA or a zero or less than zero EBITDA at all. So basically we're here to improve the competitiveness of the U.S. Manufacturing industry by helping the business owners we serve achieve their dream. So.
Okay, so our discussion today is probably for the next 30-45 minutes. We could talk for days probably on balance sheets and income statements and cash flow and bore you all with accounting pronouncements and other FASBs, and that's important information. Obviously it's what Justin and I spend a lot of time in doing, but we really want to start to challenge you to think differently about your financial information. And as Justin mentioned, your financial statements really can be completely meaningless if you're not looking at them correctly. And so we want to take a step back and challenge you to kind of rehash your current process in order to get the most value out of financial statements and your financial information that you're reviewing. So 3 main topics today. Primarily the measurements that you need to identify for your business to have a sustainable and ongoing operation. Then we're going to talk about your financial information review. We're going to refer to either financial statements or financial information just kind of as a whole and how you're reviewing that. We'll go through some things not to do, some things to do, and then we'll wrap up with a few things that every executive needs to know.
Okay, what you're seeing now is what we call the business triangle of a company, and as you can see in the middle there, the triangle is kind of the middle triangle is the leadership engine, and that kind of really what drives your business. Lower right hand quarter being the execution engine, which is your infrastructure, which basically is your management team, your operating system, etc. Lower left hand quarter is your growth engine. What are you doing in different markets with different customers? Are you growing? What are your strategic plans to grow? And then on top is our financial engine, and that is kind of what we're going to focus on today. But keep in mind that your financial measures are lagging indicators, okay? And non-financial measures, which are on the bottom, are your leading indicators. And within this triangle, every company has a different size triangle within this triangle. Obviously, this would be the perfect triangle, with growth and great infrastructure and great financial statements. Within this triangle, you can have a type of company that has great financial statements and great infrastructure, but is just not in a growing market and is not growing. So, different size triangles are within this triangle here, and it differs between different companies. So some of the measurements that we're going to talk about today is first thing is what is the goal? What do you want to get out of your financial statements? Second, leading versus lagging indicators, kind of what I talked about in the last slide, and we'll get into a little bit more of that later. The destination obviously drives the journey. What are your strategic goals? Do you budget? Does your company use a SWOT analysis, which is strengths, weaknesses, opportunities, and threats? Most companies know that they should be doing this, but not all companies have the discipline to actually do this. So the key is going to be to understand how to link the non-financial, which are the leading indicators, with the traditional financial measures, which are the lagging indicators. improve relevance. So we'll look at examples of this on the next slide. Okay, so on the left-hand side here, we have our financial measures. Remember that these are lagging indicators. These are kind of the rear view mirror of what has already happened. And then over on the right, we have our non-financial measures, which is our leading indicators. So on the left, your company can obviously look at profitability, different ratios that the bank may want and need, but what we focus on, or what we'd like you to get to focus on, is a concept called value-added revenue. And just to touch on that at a high level, value-added revenue is revenue minus your direct material costs minus your outside service costs, and that'll get you down to value-added revenue. And this is a very important concept. We're not going to get very deep into it, but if you have questions about it or want us to come and explain it to you and show the tools that we have, we can come out and explain this to you. Just let us know. But we actually have proprietary some software tools that we can load in your prior year's financial data, and we can do a value-added revenue analysis for you. We can do some what-if analysis. What if I took on this type of job? What will it do to my bottom line? What will happen if I add this type of capacity, and whatnot? So over on the right-hand side is our non-financial measures, and you can read the list there. But capacity is the key one. Management really needs to understand two things to be an effective reviewer of their financial statements, and one is their fixed cost structure, and two is capacity. Capacity is very key. Just to give you an example, many of our clients will sometimes turn away, quote, low margin or dog type work, because even though they have the capacity to do it, they'll turn it away because the margins don't look good. But really, if you do a value added analysis on that type of work, you can really see that outside of any outside material cost, that value-added revenue will fall directly to the bottom line of your financial statement. So one is you need to understand fixed cost structure. Two, you need to understand capacity, and those can really be a really good driver for your financial information. So
I'll just butt in. We've got questions on the value-add revenue. So if we'll present that again at the very end, write down, or we'll email it out too as well.
Sure.
So just want to acknowledge we saw that question.
Yep.
Let's kind of, now that you've got the basics, that slide is going to be important, those measurements that we talked about. Let's circle those into your financial information review. What are you doing right now? Maybe you're the one preparing some financial information for someone else to look at, or maybe you're the corner office that's reviewing monthly information. But most places we go, they have their stereotypical monthly report where they get a stack of paper and they look at it. And we want to focus on what's in that stack and what you should be doing with it, and how to make that work for you. The good thing and maybe the bad thing is that there's no rule. Nobody has to create a specific certain package. Usually what's been prepared periodically is just what's always been prepared periodically. But there's no rule that says here's what you have to look at every month, and here's who has to look at it and how often. That's a good thing. We're here to tell you, because that probably needs to change in most organizations, the frequency and what actually is being reviewed. The positive to that is that management really needs to drive this process. And let's just kind of pause for a minute and think about, do an assessment of what you're either preparing or reviewing periodically. Do you get that stack of paper every month, you print it out, and you spend 2 hours trying to figure out what in the world it is and what does it mean, and how do you know if you've got what you're supposed to have? Or maybe even a worse situation to be in is it just goes on the pile of last month's stack and they keep piling up and are never really looked at. We kind of laugh, but we see these situations because you're either getting too much information, not enough information, you don't know what information you're getting. So think about what your process is now. Maybe it's a really robust, mature process of financial reporting, or maybe it's a QuickBooks report of your balance sheet, income statement, maybe cash flow, and think, are there any measurements on that last slide, financial or non-financial, that just jump out of that material at you? Are what, are the important measurements obvious when you pick up that pack of information? If it's not there, it's probably time for a change. If you pick that up and you spend significant time asking questions or getting clarifications about the information that's presented to you, if you're back and forth with what does this mean, can you print this a different way, that's going to lead you to realize it's probably a time for change. And I think the most important thing is if you can't pick that up and react and make decisions on a forward-looking basis quickly, the information isn't extremely valuable, and it's probably a time for a change. And we don't have all the answers here and now. There's probably little changes that need to happen. Other instances might be a total overhaul of the information that you're pulling out of the system and doing a complete recasting of the financial information. It's a little bigger of a job, but it's something that we can help with. I know Justin had mentioned some tools. A lot of the first steps, though, with what we want to challenge you with today are small things that can be done easily and quickly, and we want to let you know, it's okay. You don't just have to pick up those financial statements and look at them. We keep referring to financial statements, but let's think a little bit about, on the next slide here, how to enhance the entire financial statement package. Your goal is primarily to make that process work for your company. We can't ignore the fact that you may have creditors or a bank or other users of that core financial statements that that may need this and may require you to present that for them. But the internal users, the decision makers, and the ones that wake up and go to bed every day with business operations on their mind, need to have a process that works for them. So how do you do that? What's your need? What is the need of the organization? Do we just need to get money to hit the bottom line? Do we have a profitability issue? Is there a strategic plan that's set forth that you're trying to, just get started or to keep up with, or you're lagging behind? That strategic plan is going to have financial information and financial measures in it, and non-financial that you're going to be needing to keep up with. Capacity and utilization and other operational issues. Do you just have a budgeting need that you need to get back on track with budget, or get ahead of budget, or catch up? What are your needs? And that's something you probably say, okay, all of the above. But really, what are those core needs that you need your financial information to do for you, to tell you? And how do those circle back into the measures of success that Justin went through? So how can those financial statements in that review process, how can they meet that need? Probably, I think if we're honest, everybody's in some type of need for a little change. And what we need to do is take some steps to go outside the typical balance sheet, income statement, cash flow. We need to be including those major metrics, the drivers, those other measurements in the financial information. And this is our goal. We want you to have a tool that's forward-looking and that aids in decision-making. I'll go into a little more about that with the next slide with what not to do. This is always fun because we're not really telling you what not to do. We're kind of telling you what to do, but in a more creative way. So here's the common pitfalls. This is what we traditionally see, and people are over-relying on the financial statements in varying forms. I'm not going to say an audited set of financial statements isn't extremely valuable, because I'm an auditor, and they sure are worth every penny.
Sure are.
But when it comes to that daily decision making, how much are you relying just on the core balance sheet, income statement, cash flow? That's in your rear view mirror, really. Those are lagging indicators. We've got a partner that likes to say he lives life through the windshield and not by looking in the rear view mirror. I think we all kind of want to be on that car going. You need to check your mirror. You need to know where you came from. You need to know what happened historically. You need to have something to reference from. But we don't want you to keep coming back to those financial statements that you're reviewing 2, 3, 6, 9 weeks after month-end close. We don't want you to keep coming back to that and saying, but I gotta look at the balance sheet, and why did accounts payable come? increased so much, or what happened to this operating expense. We don't want you to live in that financial statement. We want you to go outside of the traditional financial statements by circling in historical, non-financial data. Like I mentioned, historical data is good from where did you come from and how are we going to react and respond to that, but don't keep coming back to that historical financial information with no non-financial data there to corroborate it or to put it into perspective. We really want to get you to a point where reviewing the financial statements is kind of a non-event. You get the monthly financial, maybe some other important reports, weekly sales, or new customers, employee and capacity issues, whatever that is. Once you'll be able to look at that, spend a little bit of time, maybe follow up, but the majority of your time should be spent around the table responding and moving forward. Act on the information that you received. What caused a problem? Maybe there was a problem identified. What caused it? Do we have a seasonal issue, or are we really looking at a change in demand? What is happening? If you keep going back to that historical information month after month after month without ever getting the right information to shove you forward, you're going to be in the same spot that you're in 12 months from now. So the last thing is just not using those other leading, I guess that's a combination of leading and lagging, leading indicators to set expectations about what the financial statements look like. Now I know we're all varying roles of business owners or employees, but a really good CEO shouldn't be surprised by what you see in the financial statements. Sure, maybe there are some things that were a little higher or a little lower or a little different than what was expected, but when the financial balance sheet lands on your desk, it shouldn't be what happened. You should have a pretty good expectation, and that isn't based on what you're seeing with the dollars. That's based on those other leading indicators: your capacity, your inventory, new customers, some of the value add issues, quality, on-time delivery, some of those measures. If you're aware of those, you're going to know what the financials are going to tell you for the most part. So then naturally, we need to get everyone focused on what those non-financial important measures are. Hopefully that all makes sense. All right, so we'll talk about some of the what to-dos.
Okay. Obviously, you need a basic understanding of your financial statements. Obviously you probably have a balance sheet, income statement, cash flow, statement of stockholders' equity. We're not trying to say that these are not important. These are very important parts of the financial statement review. You need to have a good understanding of these statements. But keep in mind they're still a historical data point. Another thing you need to know and is the users of the financial statement. Outside of management within the company as a good user of the financial statements, you also have stockholders, investors, creditors, being the bank, and a lot of times the bank is interested in different ratios. They'll part of your, a lot of times you'll have a line of credit, and part of that line of credit you have some covenants that you need to meet monthly and yearly with the financial institution. So you need to make sure you're reading through those documents and making sure that those ratios are a part of your financial statement package, and that you're monitoring them monthly, if not weekly. We just don't want to give any financial institution any reason to call the loan or cease business with you. So I talk about ratios. They're a good benchmark, but often too high level is provided. Usually ratios are most important, like I said, when debt covenants hinge on them. Otherwise they are primarily good for trending instead of key measurements. So management should have other metrics involved in their financial statements, kind of what we talked about earlier, the leading indicators that might be more telling and more maybe industry specific or your goal oriented to analyze. So
Okay, those are kind of the basics of the what to do, but taking it a step further beyond the basics, where's your time going to be spent in reviewing your information, or perhaps recasting your information right now. Maybe what you're getting needs to be more detailed than it currently is. It definitely has to be more detailed than the traditional financial statement. If you are audited or have a compilation or some type of review from a firm, or have an accountant prepare those for you, it's going to be good to evaluate the high level health of the organization. But when it comes to making those daily decisions and kind of forward-looking strategic decision-making, you got to have more detail than that. I don't know how anybody could look at just one cost of goods sold line and have all the information they need.
Yeah, you really need to have that broken out.
It's got to be broken out. Does it need to go on your income statement that you're sharing, outside your organization? No, probably not. But you got to know your materials costs and your labor costs and your general and administrative costs need to be broken out in some level of detail. I imagine there's some people that are saying, that's the problem, I see too much detail, I don't know what I'm looking at. Well, that's a problem too. There are things that, if you're never looking at them, never asking questions about them, always staying the same, group them together. Don't waste your time going back and trying to rethink out accounts that are relatively stable or managed, or recurring accounts. Start drafting out your income statement presentation in one that shows you what you need to know more of. In some instances, this detail might be a little more than your controller or your accountant or you want to put together. So we're not saying to put every item on your trial balance on a piece of paper and say, here, review it, because there's no value in that either. What we found is that some companies make rules about the information that's provided. I think these are extremely helpful in that it puts the onus of the work on the preparer and not the reviewer. And what I mean by a rule is, if a certain account changes by more than 10% since last month or over a year ago, or it's 10% off budget, more information is going to be required, and the preparer has to go another level of detail or provide a short narrative about why. And I don't mean to negate what I said earlier about the surprises, but there are instances where things do get a little off track. And management should be sitting around the table and have those tools there in what they're reviewing, rather than saying, what in the world happened to this salary account? Why is it so much higher? Well, maybe it's a simple example with an accrual, or this was bonus month, or whatever happened. That information should come and allow you to look at it quickly and be able to move on. So there's no golden rule about 10% is just something I threw out, but a lot of companies do that and find it valuable and just set forth a policy in, if these happen, go ahead and prepare more information. Or if these happen, we're going to have a separate meeting to discuss X, Y, and Z. So setting out some type of policy might be helpful. But the biggest part of value in what we want you to be doing, your financial information that comes to you should be accompanied by that valuable non-financial data. Both to corroborate the information that you're receiving, but mostly just to give you that practical decision-making information that you need in order to really get a grip on what's happening with the health of your organization and to respond going forward. I don't know that I've ever been in on a conversation with management or in the course of an audit or any type of financial review where people have just said, man, we've got to get our quick ratio up, that's killing it. That doesn't happen. They're talking about inventory. They're talking about personnel and employee cost and capacity and inventory levels.
Utilizing capacity.
So what other value is there to a quick ratio or a current ratio other than to look at it for trending and for debt covenant ratios? But the common perception is we got to get this core financial information in there because that's the good stuff, and that shows everybody that we know what's happening in our organization. Not really true. There's other things that should become part of your financial information packet that are really more important. Lead time, capacity, quality, etc. I've said this a couple times already, but the financial statement shouldn't be a surprise, and I think that's kind of common sense. It might be simplifying a huge process a little bit. I imagine some people are thinking, yeah, sure, it's a surprise if I even get my financials every month. But this is our goal. Your financials should be a relatively easy non-event because you have been communicated with periodically about those leading indicators and those non-financial information. And that's really what's driving that financial report when you actually get it.
In a perfect world, outside of a few surprises or explanations, they should meet your expectations, and then it's time to look forward and fix any type of any non-financial indicators that
Yep.
that are maybe lagging. So.
Absolutely. A little more on what to do. Benchmarking. This is always one of those areas that's up for a debate. Is it good? Is it bad? Or what do you benchmark against? Our answer as CPAs is always, it depends. Relatively stable, mature organization, we like to benchmark usually against historical data. Might as well keep on being historically stable and strong and continue growth. If you're growing really rapidly or shrinking really rapidly, benchmarking against your budget is probably where you need to spend the rest of the time. Budgeting against other industry can really come into play in a lot of different areas. That's a good tool in some ways, and it's also can be a really harmful tool in that you got to be careful. We can't overvalue that benchmarking.
Yeah, if you're a growing company, you don't want to be comparing to average industry benchmarks.
Yep.
You need to create an aggressive budget to go along with your growing company, and then compare to that instead of any type of average.
Yep, and it may sound a little weird, but some CPAs, we love to benchmark the audit work that we do, but we don't always like benchmarking within the organizations that we're auditing or visiting or assisting, because it can lead to mediocrity, frankly. And no matter what type of benchmarking you're doing, no matter what your organization is, you provide a value proposition, and it comes with a specific cost and pricing model. And so to benchmark against another industry or another organization with dissimilar value propositions can really confuse and get you off track and make you kind of try and hit and miss rather than really illuminating what's happening. So we don't want to say benchmarking is a waste of time, and it shouldn't be done, because clearly benchmarking is important when you have these non-financial measures that you're trying to keep tracking and moving them forward. But like everything else that comes to you in a review, we don't want you to overvalue one thing when it comes to benchmarking, overvalue it too much. Okay, the last topic before we take any questions are two things every CEO needs to understand.
Yeah, like I mentioned before, two things every CEO needs to understand is that, one, you need to understand your fixed cost structure, and two, you need to understand your capacity. You need to understand both, not one or the other, because they both hinge on each other. And how these two work together really drives the value-added revenue analysis. And we can come and describe that to you and help you with that. But an example would be understanding your fixed cost structure and capacity is it's kind of like our business that we work in with the CPA firm. We have different times of the year where we're busier, and so therefore we need to utilize our capacity in other industries. So our tax people may be busy January through April. So May through December, we still need to utilize them. They are a fixed cost to our company, and so therefore we need to utilize them maybe in some of the audits that we're performing throughout the year. So cross-training your employees, so they can move to different other areas of your business is key. Other areas meaning in a manufacturing industry would be different machines and different components of your floor. So value-added revenue is a very key tool in this process.
So what do you need to do to take the next step? I think the most important thing, I hope we've hit it home today, is identifying what those non-financial measurements are. Everybody seems to understand the financial measurements pretty easily. Maybe you are at a point where you need a little more information, or you need the language to be able to understand what a balance sheet and an income statement looks like. That is important, and we can certainly help with it. You can spend 5 minutes out on Google and be inundated with people telling you how to read a balance sheet. But we wanted to kind of get you off that track and get you back here and thinking about what really comes into that balance sheet. And that's what you got to understand. Once you understand that, the balance sheet's going to, an income statement and cash flows, they're really going to make sense. So once you've got those identified, what do you want to see every month? What questions are you asking? What is always needing clarification? What do you always need to dig into deeper? What are those measurements? And how are you going to force those into your current practice with looking at your general financial statement review every month? So get those identified, and then evaluate how your current financial reporting review process, and I know that means different things to different people, how does it present those measurements? I mean, simply, how does it put them on paper? How does it make them obvious to you? Is it easy to manipulate? Is it easy to do a what-if analysis on it? Is it just printed out on a piece of paper with no supporting information? Do a quick evaluation with how much value you're getting out of your current review, and how well those measurements that you've identified are in that current financial reporting process. And then set a goal. You got to move and do something, either a little more detail, a little less detail, or you've got to set a goal to completely recast and throw out what you've got, and help get some help designing something that makes sense and allows you to make some forward-looking decisions. That's something that we can help with. I know a lot of times, like I said earlier, it might just be small steps toward thinking differently. And I don't need this report. I've never used this report before. Where's the value in it? What if you gave me this instead? And figuring out what that looks like and how you're going to get there. That's the end of our formal, informal presentation. We've got some contact information. Justin, you want to give the
Sure.
correct phone number?
Yeah, I'm actually in the Cedar Rapids office, and my phone number is 319-363-2697. Like we talked about before, get a hold of one of us if you want to talk in a little bit more detail about some of this stuff. We hit high level on the value-added revenue analysis, and so get a hold of me if you'd like us to come out and explain that in a little bit more detail, and maybe bring out some of the tools and software that we have that we can really drill down on some of your strategic ideas and goals going forward. So.
Okay. Good luck. Hope everybody makes a positive change towards making their financial information work for them.
If you've got any questions, feel free to ask those now. This would be a good time to do that. I actually listened to every word you guys said.
Well,
So
you don't have any questions, though, do you?
I don't.
Okay, good.
No, it was very self-explanatory.
Justin's here
which
for the
is
hard
good.
questions today.
Well, fantastic. Thank you so much. And I don't think we have any questions.
Okay.
So that means you did a good job presenting everything. And this will be available to you. We'll be sending it out through our e-newsletter on Thursday. So there will be a link there. It will be stored on our website under events and in the webinar tab, and then also on the My Intranet website. So lots of opportunity to kind of go back and catch some things if you missed them. So thank you to Justin and Elizabeth for being here. Really appreciate it. Appreciate boiling this information down so that someone like me that isn't in a financial position can understand it. So much appreciated. And again, thanks to My Intranet. Just wanted to make you aware of a few upcoming events that ABI has on the calendar. We've got our executive workshop. This is a transition planning workshop. CLA will actually be helping us with that. That's in Carroll on August 29th. So if you're on the western side of the state, please plan on attending that. All of the registration information for these events is on the front page of our website at iowaabi.org. And then we've also got a few foursomes, maybe 2 or 3 foursomes left in our golf outing on September 13th. That's at the Harvester in Rhodes, which is on the way to Marshalltown. So if you aren't registered for that, we'd love to have you there. And there's also the option, if you don't want to attend the golf outing, to just come for dinner that evening. So all of those, again, available on our website. And then also ABI, this will be our 3rd year, has started doing what we call our Connecting Statewide Leaders Receptions. We're gearing up for a new season of Leadership Iowa. Actually, this class will begin in October, and as a part of these Leadership Iowa sessions, as they travel around the state, we're gathering local leaders, regional leaders, AVI members, local chamber members, young professionals from those areas to come and just gather for an informal reception as we're in these areas. So the first one will be in Fayette. That's November 8th. And Fayette's up in the northeast corner of the state. And we're going to be on the Upper Iowa University campus there. So it's just gorgeous if you haven't been there. So that'll be November 8th. And then the next one is December 6th. And that one will be in Oskaloosa. So down in the southeast part of the state. So please put those on your calendar, and we will see you there. There is no cost to attend those. So again, thank you to Justin and Elizabeth with CLA, and thanks to all of our advisory council members for